Hey everyone, Tyler here. Today I got a packed-filled video for you today for the month of September, talking about rising interest rates, the market slowing down, exploding inflation. We're gonna go over all of that and then provide you with some tips at the end of the video on things you can do to prepare, prevent, and just get yourself in the right position so that you're better off down the road. So without further ado, let's go ahead and get started. Right here, Yahoo Finance came out with a graph that depicts where interest rates have been and where they are today. They're over 6%. And they're always changing every single day, but at least from the time of this video, that's where they're at right now. And they have a potential for going even higher. The reason for that, just last week, the CPI readings came out, which stands for Consumer Price Index, and they gave us some new readings. Here's some of the details of what happened last week. The Consumer Price Index, or the CPI, came out at 8.3% for the month of August, and it remains at multi-decade highs despite the best efforts from the Federal Reserve to get inflation under control. Now, rising interest rates, according to Gapin, said that the Fed likely still has work to do even after it raises rates again this month. He projects that the Fed will raise rates total of about 1.7% between now and February 2023, pushing the Fed fund target range to a peak of between 4% and 4.25%, meaning they've already raised it some and they're planning on raising it potentially even more. Now, if you want to get an idea of where the fund rate has been and where it is right now, you're going to see right at the bottom towards 2008, you're going to see that flat line. And that's because it was around then that we dropped it to zero back during the crash of 2008. We steadily increased it from 2011 to 2020, and then around March 2020, they dropped it again back to zero. And that's kind of where it has been for the past 2 years. Fortunately, he still anticipates the Fed will finally get inflation under control in 2023 and 2024. The thing I want you to take away from this right here is that this is potentially 2 years down the road that they're going to be able to get inflation under control, meaning they're going to keep the fund rate high. And if they keep that high, that's going to affect interest rates. Now, you might think, interest rates, how is it affected by the raising of the fund rate? Well, it's affected because of the Treasury yield, and I'm going to explain that right here. The 10-year Treasury yield and mortgage rates tend to be about the same. The reason for that is they're not correlated, they're not linked together, but they have to be competitive because people buy these mortgage-backed securities or the interest rate at a designated interest rate. And if the 10-year yield gives or provides a better interest rate for these large investors, they're going to choose putting their money in the 10-year yield instead of giving it to mortgage-backed securities. So if we want to have people have the ability to be able to purchase a home, the interest rates have to be competitive enough to where these large investors will purchase these mortgage-backed securities from banks. Therefore, the higher the 10-year yield goes, so will interest rates. And right now, they've gone up and they continue to go up to years highs. Now, let's go ahead and get looking at what's going on in our local market here in Omaha, Nebraska. Now, this is the median closed price. As you can see right here, we're seeing a big U-turn. Now, normally you're gonna see these peaks and valleys depending on the time and season of the year, but we're getting this one a little bit early, and it's gonna be interesting to see how it fares as we move into the fall and winter months. Here we have the new listings. New listings is right on trend. We have peaks and valleys at the beginning of the year. It's high in the middle of June and it goes back down as we move into the fall. So nothing normal there. It's actually down 2.9%. Here we have the number of homes for sale that has increased year over year. You can see it has increased by 29%. That means homes aren't selling as fast and they're staying on the market longer. Now, if we look at how long they're on the market, right now it's not very long. I expect this number to get higher as we move towards the winter months, and it potentially could get a lot longer as we move into 2023. Right here is pending home sales. Pending home sales are down by almost 13% year over year for the month of August, and we expect it to continue to go down. We expect the number of pending sales to decrease as we move through the fall and winter season. That this is seasonal. But really the litmus test is going to be back in the springtime. Are we going to see that large rebound like we see every single spring? Right here, we have the month supply of homes for sale. If we take a look at this, the number of homes for sale has increased. It has increased by 40% year over year. And this really is moving us back to the direction of what it looked like prior to COVID. And it could actually get worse depending on what happens with inflation, what happens with the economy moving into 2023. Here we have a showing time, showings per showing. This shows us just a decrease in the buyer foot traffic in open houses and realtors showing homes to buyers. We're seeing a huge decrease, and this is because of the rising interest rates. Now, I want to show you this graph one more time, but I want to add a few years on this. I move this out to 5 years. I want you to see the trend. See how it goes up consistently? You see this up and down graph? Well, if the market changes, you can expect it probably to do the same on the other end on the way down. So if you want to know how long this could potentially last, because you're probably asking yourself, well, Tyler, how long do I have to wait before I buy a home? Or should I buy a home now, or should I wait? Well, the answer to that could potentially be based on what it looks like, the mirror image of this. Now, if we take this and we look at the median home values over the course of a long time, we see the spike right here, right in the center, is around 2007. And you're gonna see this graph go up and back down, and it's pretty smooth. It wasn't until 7 years later that the highs of 2007 became the highs of 2015, 2016. And that took 7 years. So, in other words, if you're thinking, well, I probably need to sell, or I'll just wait through this, it could be 7 years before you see these potential numbers again. And if you're in a position where you're just looking to find a home and stay there for 5 to 7 years, it should not be a problem to buy right now. You do what's in the best interest of your family. Now, interest rates are going to go up and they're going to go down. They could be higher at an elevated level for the next year to year and a half, and we could see them go down then. And at that point, you could refinance your home into a lower interest rate. So if you're planning on being in a home for 7+ years, it's okay. If you're planning on moving within the next 3 to 5 years, you might want to consider what you're going to do if the home value of your home goes down. Now, if you're looking to buy a house and you're just trying to invest into real estate, I would recommend waiting. I think the market is going to go down further. I don't know how much, but based on the trends that we've seen in some of these graphs, it could be around that $20,000 below what the numbers we're seeing this year. So hang on tight if you're an investor. If you're a first-time home buyer, you're going to want to make sure that you're in a good, strong financial position. Don't stretch yourself too thin. You want to make sure you got good amount of money saved in the bank for emergency funds. You're going to want to make sure you have that extra cash flow above what you would be able to pay for your mortgage, for your living expenses. You don't want to stretch yourself too thin, especially we don't know what 2020, the rest of 22 or 23 could hold as in regards to the economy. I hope this was helpful to you. And if you're even thinking about buying a home or you have questions, more detailed questions, please reach out. We have people from all over the country and world, and even here locally, that reach out, guys, and I absolutely love it. I would love to help you, so I look forward to hearing from you. Take care, God bless, and we'll talk to you soon.